Covered call funds would never recover from a real market crash. Well, this one did, and the 2008 global financial crisis was pretty bad. Covered call funds always underperform the underlying asset. Well, mostly that's true, but not all the time. Here's a NASDAQ covered call fund during the 2008 GFC. The NASDAQ wasn't always ahead. Covered call funds pay juicy yields, but if you're wondering just how resilient they are, today we'll look at what the 2008 global financial crisis did to one of the oldest covered call funds. It's called QQQX, and it's currently trading at a discount.
Armchair Income.
Some investors buy REITs like Realty Income because they can see the history of consistent income that wasn't affected by events like the 2008 global financial crisis. And yes, that is a good-looking distribution history. But Realty Income pays 5.5%, and I'm looking for at least 8%. Covered call funds will get you 8+% or more. But as I mentioned in a recent episode, they're relatively new. In that episode, we went back 10 years, and BST had a pretty good track record of paying roughly 8%. Then a viewer brought to my attention that we can go all the way back to before the 2008 global financial crisis with a covered call fund called QQQX. Thanks, Brad. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, and this channel is where I share what I learn. I mostly focus on stocks and funds paying consistent yields of 8 to 12%, and if you'd like a copy of my portfolio, it's available via Armchair Insider, link in the description, it's free. Now, this won't be a full review of QQQX, we're just using it to see the impact of a full-on market crash. I think most of us have forgotten just how bad the 2008 global financial crisis was. It wasn't a dip for just a few months. The NASDAQ was cut in half. Can you imagine if you spent your whole life building $1 million nest egg back then, only to see it shrink down to $500K? If you bought the NASDAQ back in November 2007, you had to wait 3 years for your portfolio just to break even, let alone show some gains. So much worse than the 2020 pandemic or the 2022 bear market. Nuveen's QQQX covered call fund was launched just before this mess began. It came out in January 2007, so it had a nice little run for about 11 months and then 3 years of, well, don't look at your brokerage account. The effect of the GFC is pretty obvious. At the end of 2009, the fund manager made the biggest cut in the life of the fund, 31.7%. So the NASDAQ fell almost 50%, but the income didn't fall by as much as that because it's a managed distribution, and by the time the fund manager made the change, the NASDAQ was well on its way to recovery. A 31.7% cut is bad. But imagine if you owned a big name bank stock back then, like Wells Fargo. They cut their dividend by 85%. Or Citigroup, they cut their dividend by 98% and it never came back. As the market recovered, the QQQX income trended mostly up. It took about 12 years for it to reach new highs. The 2020 pandemic didn't affect the income, but then the 2022 bear market gave it a little whack again. The good news is it's now at an all-time high. Snowball is handy for distribution charts like this, but I mostly use it to combine my stocks from 3 brokerages into one dashboard. I can rank by yield to see how I want to rebalance my portfolio, and the calendar function lets me see how many dollars will arrive on any given day of the month. Link in the description for a free trial and a discount. Let's take a look at total return, which combines price action with the distributions. December 2007 to December 2009 makes QQQX look pretty good. It followed the NASDAQ 100 down and then managed to outpace the NASDAQ on the recovery. That's unusual for a covered call fund. Normally they lag during a recovery. QQQX is an actively managed fund, so I'll give the fund managers some credit for their stock selection and option trading during that period. The fund is loosely based on the NASDAQ 100, But the portfolio consists of just over 200 stocks, which is double, obviously, the Nasdaq 100. So clearly there are some differences between the two. We saw earlier that the pandemic didn't affect the QQQX distributions. However, as far as total return is concerned, the Nasdaq 100 left it in the dust. The 2022 bear market was slightly better for the QQQX covered call fund than it was for the underlying Nasdaq 100 index. And when I say better, it lost slightly less. And in that case, it looks like the difference was just the option income received by QQQX. So mixed results for the down market periods. Before we move on though, it's important to remember the big picture, which is the full 18.5 years since QQQX was launched. The Nasdaq 100 has delivered a far superior total return. This is why it's better during your working years to focus on growth rather than income investing. It also depends on your frame of reference. Even though they're different asset classes, many retirees will consider a REIT like Realty Income. At more than $50 billion of assets under management, it's extremely popular. The steady income we saw a little bit earlier in this episode is impressive, but if you held QQQX for the past 10 years, you would have received a higher yield and a significantly higher total return, roughly double. Normally, I wouldn't address pricing for a covered call index fund because they're mostly ETFs. That means their price and their net asset value are the same thing. So, for example, the price of QQQI is equal to the value of the Nasdaq 100 shares that it holds divided by the number of shares. You can debate whether the market is over or undervalued, but that's a separate discussion. QQQX is different in that it's a closed-end fund. The difference is that ETFs issue and redeem shares every day to keep the price equal to the net asset value, and closed-end funds don't. The number of shares in a closed-end fund is fixed, which is why it's called closed. This means it can trade at a price above or below the value of its assets. As I record this, QQQX is trading almost 8% below the value of its assets. As an income investor, the discount directly translates to more income. QQQX is using its assets to generate a yield of 7.78%. If there was no discount, that's the yield that you would receive. But the discount means you can buy this income stream and pay a price of roughly 92 cents on the dollar. The result is that instead of getting paid a yield of 7.78%, your discounted cost basis means you get paid a yield of 8.38%. It's not as simple as the most discounted funds are the best funds. If a CEF is always heavily discounted, it can mean the market just thinks the fund is not that good. But in this case, sometimes QQQX trades at a discount and sometimes it trades at a premium. I think QQQX is an okay fund, but I don't hold it because I prefer some of the newer funds like QQQI and GPIQ. QQQX might be a fit for somebody who likes trading in and out of CEFs based on price to NAV. In other words, buying it at a discount and then selling when it's at a premium. If you enjoy that kind of thing, you could improve the total return beyond what you'd get by just sitting on it. And if you want to learn more about QQQX, this analysis by Kane Lee goes into more detail about the portfolio and the option strategy and compares it to STK, which I'm also a fan of. Kane is one of my favorite analysts on Seeking Alpha. I'll link to Kane's article and I'll also include a link for a free trial and a discount. I'm on Seeking Alpha pretty much every day and I use the premium level of membership. The point of today's episode was to show that even though the most popular covered call funds don't have that much history, the strategy of selling call options isn't new and it's not going away. A major market crash hurts most asset classes, including covered call funds. The income falling by a third, yes, that was bad, even though it eventually recovered. For this reason, I diversify beyond just covered call index funds into other asset classes like corporate bonds, CLOs, midstreams, gold, Bitcoin, business development companies, etc. If you want to find videos of my favorites, click here for reviews focused on the top 10 holdings currently in my portfolio. That wraps it up for this look at what the GFC did to a covered call index fund. More Armchair Income coming soon.